So that's the basic vocabulary of the market. The uptrend, the downtrend, and there's a sideways trend. There are three states of the market. There's an uptrend, a downtrend, and a sideways trend. And the market is always in one of those states. You can say that with virtually 100% reliability. For example, here's a side trend that we just saw in the S&P, where you see from basically from here to here, you have sideways movement, almost no movement in price whatsoever. Now, when this occurs, obviously, you could sell straddles. You could buy straddles. At some point, there's a question of timing here. You can sell straddles for a while, but then as it lasts longer and longer and longer, you have to get out of the selling the straddles and buy straddles, because it's going to break out at some point. You could time that. You could time that by seeing when this upper resistance line is broken. When it's broken right there, then you don't want to be short any more straddles, okay? You want to be going long. Now, here is an illustration. What you want to do, or what trend traders want to do, what technicians want to do, what those who trend trade the market want to do, is get on a trend and stay on it till the bloody end. I mean, you want to, and in the meantime, you take movements against your position. Okay, so here we have a pattern which is universally appears in the market, which is an up wave, a down wave, an up wave, a down wave. So the basic pattern, and the way you know that you've got a bull market, is you have higher highs and higher lows. If you have a bear market, you have lower highs and lower lows. So that is a shorthand way of analyzing the market. This particular slide shows a method which was developed by John McGee, and which I adapted and further developed, in which a system of stops is put in according to the wave lows in the market. So here's a wave low, here's a wave low, here's a wave low, and when you get a wave low like this, then you use that as what McGee called a basing point. And on that basing point, you set a stop down with a filter. You set it down depending on the volatility of the instrument. And usually, let's say just offhand, you might say I usually use 5% or 6%. The reason for this is because stop hunters watch down waves like this to catch people who've set their stops too close here. Jack Schwager in Market Wizards interviewed Bruce Kovner, who is a famous and very large currency trader. And he asked Kovner, where do you set your stops? And Kovner said, where they're hard to get to. This kind of stop is very hard to get to. This kind of stop runners can't get to unless the trend has truly changed. Okay, and in fact, you can use this as an indication that the trend has changed. So I'll talk more about that later. But let's say when you're looking at a trend, for example, I've been doing this for the readers of my web letter and for myself and my family accounts since March of '09. And so I call it stair stops. You get a wave up, get a wave down, you recognize a basing point, and you set a step down underneath it, and you can see how the stop is consistently rising like stair steps and consistently locking in your profits. It locks in your profit without allowing you to be chased from the market by stop hunters, by news traders, by Goldman Sachs, you know those guys. So here's an example of the 2007-2008 top. I don't have the stair stops drawn on this, but you can see the stop. The stop was 12,603 in January of 2008, and that avoided all the grief and trouble of the 2008-2009 bear market, right down to March of '09. In this particular case, since we're talking about how you analyze trends, this line is coming from March of '09. When you have a trend line of that length that's broken, you have very serious consequences. This is a case of what Jung would call synchronicity, because right about where this line is here is the stop that was calculated from a basing point up here. So two methods combined in what technicians call the rule of multiple techniques. The rule of multiple techniques says that if you get the same result from two measures, you have an especially strong case. Let me make the point that this is not idle hindsight or 20/20 hindsight. This was the analysis that was made at the time, and anybody can go on my website and go into my archives and see the letters that were written at the time. This is an extremely powerful technology. I mean, it's you know, I don't know how. I mean, I don't know how people deal with a top that don't have tools like this. I mean, and you can see it right now. The blogosphere, the pundits, the talking heads are all saying, "Oh, time to get out of the market. Oh, the market's going to crash. It's going to check." You know, I mean, buck, Chicken Little. And they don't know. They honestly don't know.
I see double top or triple top is the only indicator the market went down.
I'm sorry, excuse me?
I see double top or triple top.
Yes, this was a double-headed head and shoulders, actually.
That too.
Yeah, it was. It was a double-headed head and shoulders, and you know, that was 100% obvious at the time. I mean, it was an analysis, it wasn't an opinion, it wasn't a guess, It wasn't I think this or I think that. It was an analysis. The analysis coming straight out of the Edwards-McGee technology. Here's another look at it, which comes a little longer. You can see the trend lines coming in from farther back here. The characteristic of trend lines broken at tops is that you get short-term trend lines broken a month, 2 months, 3 months. Then you get a year-long trend line broken. Then you get 2 or 3 year trend line broken. And finally, you break a trend line with the power of the '09 trend line, and then all hell breaks loose, which is exactly what happened. So you can look at these, you draw lines on charts, and when you get these warnings from the breaking of the short-term trend lines. I can't hear you without a mic. Can you hear?
I didn't hear that either.
If you were to short this pattern, where would you get?
If you were to short this pattern.
Oh, okay. Well, that's actually very obvious. The obvious short, let's say the conservative short, is right in here. Okay, on this line. The more aggressive short starts here, continues here with an add-on, and then when this line is broken, goes all in. So depending on how aggressive you are, what can happen to you when you're too aggressive, when you've just broken a very minor trend line and you're anticipating that longer trend lines will be broken, sometimes they're not. Sometimes there's a short downtrend.
I like all your lines, but I don't know how to draw from start, you know.
I'm going to show you.
All kinds of lines.
I'm going to show you. You do it with a ruler. Okay? In fact, I have a book called Zen Simple, Beat the Market with a Ruler. And believe me, it works. I'll get to those in just a minute. Now, so we have uptrends, we have downtrends, we have side trends, we have tops. In this particular case, that top could take several forms. It could be a double top, it could be a triple top, it could be a complex top, it could be a head and shoulders top. Okay, so there are a number of different formations there that a technician recognizes almost instantly. Now, you don't act on them. One of the tenets of good trading skills is you wait till the formation is complete. Because if you try to go into incomplete formations, like recently here, the Qs made a rounding top, and it looked like they were going to make a head and shoulders top, and then it got wiped out, and the prices went on. It canceled what was happening.
You mentioned when the pattern is complete.
Yeah.
So could you enlighten the rest of the audience as to how do you know when the pattern is complete?
Well, the pattern is complete in that particular case. Pattern is complete in that particular case when the prices break below the neckline here. In other words, before we see this right here, if that weren't present and you got this bar right here, you would know that you had a trading signal. Now, I sometimes call these kinds of bars, I call them power bars. Okay? They're power bars because they're so vigorous that you can't miss them. And when you get that kind of behavior, the market is telling you, okay, that there are a lot more sellers out here than buyers. And we get a run like that. Some technicians would call it a run day. When you get that, then as frequently happens in this particular case, as frequently happens when this line is broken, there's a rally which brings it back up, because the naive and the inexperienced are looking at it and saying, this is cheap now. This is cheap now, I'm going to buy some of this. I never think in terms of cheap or expensive. I mean, the market's where it is, and the concept of cheap or expensive is, as far as I'm concerned, a useless concept. I mean, I know that there are managers who make their living buying cheap stocks, but I think that's a misleading concept.
I wonder if you had any indicator that would help clarify some of the stuff.
That would what?
If we had any indicators that would verify some of the stuff in terms of without going line.
Well, the indicator is the trend line.
Well, no, I'm talking about, you know, MACD or RSI.
Oh, well, you could use those things, but I find them to be just mainly a distraction, because I mean, you see what's on the chart and you get led astray by indicators. I mean, I call them natural and unnatural systems. And I characterize unnatural systems as systems that put an algorithm between the trader and the price. Okay, so you can get an algorithm that says, oh, this is oversold, this is oversold, and it'll go on and be more and more. It'll be oversold till you're broke.
So are you saying that you never use any kind of indicators?
No, I don't use anything but the price.
Right, that's why I want you to. Many people won't understand the classical, that you only use price.
That's right. You can look at the volume is not unimportant, and sometimes it's very important. But is there anybody here that ever made money trading the volume? No, you don't get paid for buying and selling volume. You get paid for buying and selling the price. So in a minute, I'm going to, let's see, okay, we saw this slide. Here is an invitation to buy leaps. This is the silver market, and it's what technicians call a rounding bottom. A rounding bottom, as you can see, prices go down and down and down, and they round and they round and they round. They labor back up. They labor back up until they get to where the pattern started. And the implications, let's see, I think this was, yeah, the prices here were less than $10. Okay, so you can take one of the technicians' measuring points is to take the distance from this line to the bottom and assume that when this issue breaks out, it will go this distance again. And indeed it did.
I think a very good point you just mentioned there is that you can forecast where the trend is going by measuring the distances, and I suspect many people don't probably fully understand that.
I'm going to get into that in a minute.
Okay.
Right now, what I want you to see is a particular kind of bottom that speaks to the technician, and which is an advertisement of an unparalleled trading opportunity. Okay, you see this, you see the rounding bottom in silver, and you can compute it and you can buy it. You just have to manage it like every other trade. Okay, and in fact, you see the trend line here. You see this trend line. I mean, some aggressive traders will kind of try to get a jump start on the pattern and buy there at the bottom, and that might work, and it might not. In this particular case, it would have worked. The same thing, the exact same thing happened in gold. There was a huge rounding bottom in gold that I have been talking about since 2003. This exact same thing, the huge rounding bottom that advertised the bull market in gold.
وشكرا لحسن متابعتكم ودعمكم لنا بالاشتراك على قناة ثقافة الكورية حتى يصلكم كل جديدنا بالوقت المناسب.